Welcome, I'm your host Anurag Gupta, and you're watching Asymmetric Bets. Asymmetric Bets is a channel where we apply ACT framework to different companies and stocks. Today, I'm going to share my journey of coming up with the ACT framework, how it helps me protect and grow capital, how I understand the various aspects of the framework, and what metrics I use to evaluate different companies in on the framework. We're going to discuss all of that. Before we start, a quick disclaimer. This is for educational purposes only. It's not a financial advice. Please consult your financial advisor before making any financial decisions. Okay, so my investment journey started back in 2004 and 5. And in case you're wondering, yes, I am that old. I started doing it with my father in an emerging market. And one of the very first lesson that he taught me was to focus on blue chip companies, the large cap companies. Shout out to my father, Dad. Thank you for that advice. I still follow that, and it has worked pretty well for me. But coming back to the story, we started looking at large cap companies. We were very careful on the price we paid, the valuations at which we entered, and we held them for a long period of time until 2008 when the financial crisis really hit. And we were actually very fortunate to get out of most or all of our investments, and that worked out pretty well for us. But the first lesson that I learned from that experience was that value investing and long term investing really works. Now let's fast forward to 2020. This was the COVID era, and I was looking for opportunities in the US market. And what I noticed was that almost anywhere and everywhere I looked, there was no value to be found. Everything was trading for upwards of 25, 30 times earnings, and I struggled to find any meaningful companies to invest in. In the hindsight, there were companies that were trading at a pretty reasonable and at a pretty good value back then, but I could not identify them. And the reason for that is I was not looking at the right spots. I was following the financial media, I was following the Wall Street, and what was the fashion of the year, fashion of the month was what I was looking at. So the lesson number two was I need to understand, I need to get better at identifying where should I go and look, where should I fish. So finally, I was able to identify some companies that were good value. I identified CVS Health. It was trading at 8 to 9 times free cash flow. It had a long term track record of generating a lot of free cash flow. It had a ton of debt on its balance sheet, but it also had leadership positions in two of the three business segments it operated in. But the stock remained cheap forever. And that led to the third lesson that I learned about return on equity. I understood how a business that generates $50 of free cash flow, $50 of return on $100 of capital invested in it is a far superior business than a business that generates $100 of free cash flow on $1,000 invested in it. I learned the concept of return on equity and the importance of that. By the way, if you want to understand this concept, I highly recommend Pulak Prasad and his book on what I learned from Darwin about investing. He explains it tremendously. Let's fast forward to 2022. This was the period when the cost of capital went up and a lot of favorite great businesses like FANG stocks actually came down. This was the period when I saw the downfall and the subsequent rise of Meta. I was also fortunate enough to participate in it. But the lesson that I learned with Meta was that track record, historical long term track record of superior financial performance indicates some character of a company that you can count on for it to come out of bad times. And in case of Meta, they had very good financial performance for 10 to 12 years. Superior growth rate, great return ratios. In addition to that, they had actually demonstrated that they can navigate technology shifts pretty well. They had done that for shift from PC to mobile, from text-based formats to images and video, And in 2022, they were staring at another technological shift from long term or long form video to short form video, as well as they were trying to overcome the Apple privacy law, privacy issues, which they eventually did. And the stock went from $90 to whatever it is right now, to $700. So, all in all, these are the 4 or 5 lessons that I try to distill in the ACT framework. We are going to look at that next and understand what each of those letters really mean, how I wrap my head around it, and what are the metrics I use to evaluate companies on those 3 parameters. ACT stands for asymmetric compounders with time on their side. And we are going to start looking at A first. So A stands for asymmetric, which essentially means we're looking at opportunities that have low risk, the downside is protected, and they have high upside potential. So it gives us that asymmetric payoff. We are taking low risk, but the rewards can be huge. And you may ask me, why do I look at only asymmetric opportunities? Why do I look at stocks that are down and beaten down? Why don't I look at companies that are growing very fast, and the price continues to go up? And the answer to that is yes, I can look at those things, but oftentimes by the time I get into those companies, by the time I discover them, their price will be bid up already. And even if the growth rate pans out, I may not make 20% IRR, because the market may move on, they may not command the same valuations, or if the growth rate reduces just a little bit, the stocks will actually be butchered and the price may fall off a cliff. So there is no margin of safety. The second option you may ask me is, hey, why don't you look at companies that may be big in the future, that are small right now? Try to predict the next winners. And nobody knows the future. And I know for certain that I cannot reliably predict which company will be the next NVIDIA. So what has worked for me in the past is look at established companies, look at companies that are currently unloved. Their price is beaten down. Nobody is talking about them. There may be something wrong with the sector, or there may be something company specific. But try to identify a floor for such companies' stock price and figure out how far are they from that floor. Now, that floor can be because of the free cash flow they generate, the dividend they pay out, some kind of value that's in their balance sheet, some investment in another company or something. And that can give me the margin of safety, right? Some of these things, some of the metrics that I use to evaluate this are, I look at the free cash flow and the free cash flow yield, and I compare it to the alternatives available to me. I also look at the debt, because oftentimes debt is a big risk. If the business deteriorates, EBITDA goes down, company may be looking at a bankruptcy risk. So I want to avoid that situation. And then a lot of times there is a good reason why such companies and such stocks are down so much. Their free cash flow may be impaired. They may not be generating any profits. They may have done a bad acquisition, because of which their balance sheet looks pretty bad. And in those situations, what becomes important is to figure out and be comfortable with the turnaround. Figure out what will be the catalyst because of which the situation will change. How long can it take? Am I willing to wait that long? And if for some reason the situation deteriorates, am I going to buy more? Am I going to hold or sell? And I'll give you an example. I was looking at a company a couple of years back, which was the biggest genomics instrument maker and consumable seller to all the research companies, pharma companies, and for clinical genomics. And they did a bad acquisition. They were trading for 14, 15 times the free cash flow. The free cash flow was still there, although it was hidden because of the integration of a loss-making business, and they were spinning that off. So if I could double click and look at that free cash flow and draw comfort that at 6% yield, they're trading at higher than the alternatives available to me. And once they spin off this loss making company, focus on their business again, they are a leader in this space. They can actually come back, and the stock can be an asymmetric payoff. um, so those are the kind of things that I'm looking at. But to really draw comfort on what will be the catalyst for change, how long will it take, and how comfortable are we with it, we have to look at the second aspect of the framework, which is C. The next part of the framework is C for compounders. And here we are trying to understand three things about the business. First, is the business a compounder of wealth over a period of time? And this can be understood by looking at the return on equity of the business. Sometimes the return on equity can also be juiced up with debt. So we also look at return on invested capital, which considers both equity and debt in the return calculations. And this is really the closest metric to understanding the moat, the compounding effect, as well as the efficiency with which the management team runs the business. I learned a lot about this concept in this book from Pulak Prasad, What I Learned About Investing from Darwin. If you would like to understand this in more detail, I highly recommend you go through this book. But coming back to our topic, in addition to return on equity, we also try to understand the moat of the business, whether the business has advantages of a brand. Is it a franchise? Does the business have some technology advantage? Does the business have economies of scale, or network effects that are going for it? There are various kinds of competitive advantages that I specifically look at to understand the moat of the business. And then the last thing that I try to do is I try to understand how has the management run the business over a period of time. Have they been a good operator? Have they consistently reduced costs? Have they been able to grow the business? What have they done with the free cash flow that gets generated? Have they distributed that to the shareholders? Have they bought back shares? At what price and valuation have they bought shares? Have they made smart acquisitions or poor acquisitions? Are they destroying wealth, or are they a good custodians of the wealth and the capital that belongs to the shareholders? At this point, I want to actually show you the return on equity chart for Apple over a long period of time, so that you get a sense of why Apple is such a coveted stock, why Warren Buffett likes Apple, as well as why he likes Tim Cook so much. So here is a long-term return on equity chart for Apple. And if you look at it in 2010 to 12, around that time, its return on equity was 36%. And steadily over a period of time, it has jumped to over 100% now. Now, this is the reason why Warren Buffett really vouches for Tim Cook, and he loves him as the CEO of Apple. With this, we will move on to the last part of our framework, which is T for time. With this, we will move on to the third leg of the framework, which is T for time. And here we are trying to look at two things. We are trying to understand the historical track record of the business, how established it is, for how long has it demonstrated superior financial performance, and can that give us the confidence for the future? And the second thing we want to look at is we want to look at the opportunity ahead of it. How long is the runway for it to keep growing in the future? Remember Meta? I talked about how the stock had gone down to $90. But if we look at Meta at that time, it had a track record of 12 years of very, very good and superior financial performance, great return ratios, as well as ability to grow its revenue. Not just that, it had also demonstrated that it could successfully navigate changing technology landscape. It made the shift from PC to mobile-based platform. It moved from image-based formats to text-based format to images and video. And these are the things that can give us the confidence that there is something inherently in the character of this company that it can adapt and it can beat the competition and continue to grow in the future. Because after all, we are not looking at just the historical performance, and if the market is saturated, then the business has nowhere to go in the future. And what we are looking for is investment opportunities where we can invest for 5 year, 10 year, or even 15-year period and let the money compound. So with that, that's why T for time, both from an established track record and the future runway perspective, how time is critical in our framework. So, friends, this is how I identify time to act: asymmetric payoffs, compounders with high return on equity, management teams that are good operators and capital allocators, established track record, as well as future runway. If you like these kind of educational videos about value investing and finding great opportunities, please hit like and subscribe. Thank you for watching.